Ladies and gentlemen, once again, good afternoon. I am sure you're well fed. Good afternoon. Yeah, first, really, just to say we are really grateful that you made the time to join us this afternoon as we look back into the year 2021 and reflect on our performance as a bank. We really appreciate that you left your busy schedules, created time to be with us this afternoon, and we thank you. My name is Charles Wakabi. I'll be your MC for this afternoon. We will run quite a tight program. We recognize the need for you to file your reports and stories, and so we'll keep it short and engaging. Let me take this opportunity to welcome those of you who are following us online on YouTube and LinkedIn. We welcome you to leave us your feedback, comments, and those of you in the room, if you are tweeting or posting on any of the social media sites, the hashtag to use is hashtag Absa FY for full year 2021 results. If I say that again, Absa FY 2021 results. Just before we begin, I'd like to just take a moment and introduce the bank leadership in the room, starting with our Managing Director, Jeremy Awori, our Chief Finance Officer, Mr. Yusuf Omari, Chief Strategy Officer and Finance Director for Corporate and Investment Banking, Mr. Moses Muthui. I will not ask those to stand up because they'll be addressing you from this podium, but I'll ask Mr. David Hardisty, who is a Retail and Business Banking Director, to just stand and wave. Mr. Ken Kanyarati, who is a Compliance and Legal Director for the bank. Christine Mwai, who is a Country Credit Director. And Mr. James Agin, who is the Corporate and Investment Banking Director for East Africa region. All right, with that done, without much further ado, I'll just ask Jeremy to come on stage and make his remarks. Jeremy will then hand over to Yusuf, who will then hand over to Moses. Thank you.
Thank you, Charles. Good afternoon, ladies and gentlemen. It's my pleasure to welcome you here for our results release. We're slowly adjusting to the fact that we can meet in person as opposed to meeting virtually, as we've had to experience over the last 2 years. And we're just managing that transition. So I'd also like to welcome those of you joining online and thank you for joining as we release our results today. I think without further ado, I'll jump straight into the presentation. I'll give a bit of a business overview, talk a little bit about the macros, and then some of the financials, and then I'll hand over to Yusuf, who will take us through the more detailed financials so that you can get a sense of that. And then Moses will come in and talk a little bit about what our future plans are. And then I'll come and wind up, and then we'll get into Q&As. So if we can move to the first slide. I think when we look at the macroeconomic environment, it's obviously been quite turbulent over the last 2 years and 18 months in particular. But I think what's very encouraging is that we're seeing our GDP starting to recover. And that's not just unique to Kenya. I think it's across the globe and also across sub-Saharan Africa, and that's what we're showing there. And I think it's very encouraging that we're starting to see quarters of strong recovery and strong performance in the Kenyan context around construction, information and technology, education, real estate, and finance. And I think that is one of the things that we're very encouraged about, and we're seeing now a bit of a rebound in terms of the GDP, as services really start opening up, and I think that's very encouraging. We're also starting to see even tourism, I guess, with the removal of some of the red lists and the requirements to have to do quarantine, encouraging more people to travel. And any of you who have traveled are seeing that planes are now quite full, and we hope to see our tourist numbers increasing. If we go back to sort of 2019, we had tourist numbers in the region of about 1.3 million. In the height of COVID, there were about 400,000 tourists, so that was a massive drop. And now we're sort of in the 600,000-700,000 level when you look on a year-on-year for the time of year. So it's quite encouraging, and we hope to see that continuing. So with Kenya, as we look through, the economy really advanced in the third quarter by 9.9%, which I think was very encouraging, with an improvement of, in the previous quarter of 10.1% as well. So we're really starting to see that expansion coming through, and I think the easing of the COVID measures should encourage us. When we look at exports, we're seeing now exports posting an 11.7% growth rate compared to the previous year. So we're at about 6.7 billion, according to data from the central bank. And I think what's encouraging is we're seeing it's being fairly broad-based growth in double digits across the different segments, and with manufacturing goods posting a 33% growth, on a year-on-year basis. On the import side, imports have been growing faster than exports, and have registered a 23.6% growth to 1.8 trillion or 16 billion. And this isn't altogether unsurprising. As the global trade corridors start to open and businesses get more confident, they're importing more to run their respective businesses. So that's largely to be expected. And I guess more recently we've seen the impact of increasing oil prices featuring its way into those numbers. I think when we move to the banking sector remains stable with strong liquidity and strong capital adequacy ratios. So I think there's a lot of confidence, from that perspective, because you need a healthy financial sector really to encourage and boost the economy. We're seeing non-performing loans standing at about 13.1% in 2021. And I think obviously we'll see now how that moves over time, to boost the speed of economic growth. At a broader level, there have been various initiatives that have hopefully made ease of doing business better, and we hope to see when the next results come out further improvement. But if we're sitting about that 60 out of the 190 economies position, I think that's credible that we've seen a number of the financial sector reforms and the doing business reforms really having an impact, whether it's improvement in dealing with construction permits, making it more transparent and making it faster and more digital, whether it's investments in electricity and delivering to the last mile, and also having more reliable electricity. And we're seeing that really coming through with modernization of the existing infrastructure, and the inauguration of the new substation in Nairobi. Whether it's protecting minority interests and investors, I think that's also an important part of encouraging foreign direct investment. And then we've seen all the e-citizen initiatives around doing things online, whether it's paying your taxes through iTax or procuring government services. And then last but not least, resolving insolvency cases. We've seen the changes in that and making it easier, to process that. On the interest rate side, we've seen the central bank really hold its benchmark lending rate at 7% for the 10th consecutive time. And that has been very encouraging in terms of from a stability perspective. And they're obviously balancing inflation pressures also with encouraging household spending and business investments to boost economic activities within the country. Now, as we move on, we can have the next slide. This slide really just shows how much our business has changed, over the last few years. When I came in 2013, I found something like this, what you can see here, under 2011. And we looked at, I felt it was important with the team that we diversify out our revenue streams to drive growth. And you can see the transition here to what Absa has today. And we really focused on growth, transformation, and returns, with a view to really driving this diversification and driving a broader financial services group with a broader proposition set. And that's essential for us to drive growth in our market share and growth in our revenues as well as profits and dividends. So as I'll show you now, I think we're seeing the fruits of that coming through. In terms, no, go back a slide, still go back, right? We're seeing the fruits of that coming in, and we've got many new businesses that weren't there before. We didn't have a fixed income trading business in 2013. We've now got that. We didn't have an insurance business. We've got that. We didn't have a brokerage business. We didn't have an asset finance business. And those are just a few that we're looking at. We're becoming a much bigger player in things like mortgages, SME. And we believe these are the areas that are critical to support, because they're critical to the driving economic growth. And if we're driving economic growth and our customers are doing well, then we will be able to do well. So if we move to the next slide. So this at a high level is our financial performance, where you'll be able to see, how we've done here. We're pleased to see that our revenue really is starting to pick up good momentum, and we intend on continuing to drive that. And that was one of the things that I'd committed that we would do as a bank. When I came in, our cost-income ratio was closer to 60%, at that point. And now we said we wanted to get to sub 50, and we're at the 45% mark, which I think we're very pleased about. We've seen our assets grow by 2.6 times, and our capital also grow by 1.8 times. And the reason why we're growing that is because we have confidence, and we believe that we want to continue investing in these businesses, and we need capital to do so. And when we looked at these results, what we're particularly proud of, and it's interesting that just seeing the two numbers doesn't reflect what happened between 2011 and 2021, right? We've had interest rate caps, we've had COVID, Corona, it's been quite a roller coaster. And we're very pleased that we could deliver a profit before tax in excess of 15 billion. So you can see the number there coming through in an ever competitive market, that Kenya is. And what we've done is we've adjusted to the needs of the time, to our customers' requirements, by investing in more digital channels, automation, and that brings more consistency of service, but it also brings down the costs in terms of being able to focus on straight-through processing. We've adjusted our branch footprint really to reflect the needs of customers, and we will continue to open branches as and when we see fit, but we'll be investing more in digital channels, and automation. And I think if there was a positive of COVID, is that it forced many of our businesses, including ourselves, to adjust to the realities of digital. I mean, we would never have thought we could do AGMs online, right? That we could release results online from wherever. People can work from wherever they choose. And I think we're going to keep the best of those as we run our business going forward, and obviously intersplice with, physical meetings and obviously seeing our customers. If we move to the next slide, please. I think I really want to state here, we were very pleased and proud to be able to play a role in supporting our customers. When COVID broke out and we really started to see a lot of the severe measures coming in, we took a decision as management, supported by our board, to really get behind customers. And we were the first bank to come up with moratoriums and restructures for our customers' loans. Because at times like that, when customers are in dire straits and it's due to no fault of their own, you can come down with a hammer on them, but that's not going to help you if you've lost your job or if your business is closed. So we did those restructures, and we restructured over 62 billion shillings of our portfolio. And that was over 60,000 customers when you look at it. And we're so glad that, that 95% plus of these accounts are now back regularized. And I think it shows how important it is to work with customers through their difficult times and not be a fair weather friend. We're also very proud that we have lent gross lending of 128 billion in 2021. Again, showing even though the times were complex, we still wanted to be behind our customers and encourage them, through support on lending. And our total assets have grown, as you can see here, to just shy of 430 billion, to support both businesses and the sovereign. If we can move on. Now, part of what is behind our strategy is really to drive transformation through a variety of things, including innovation, including our culture. And we focused, these are just a few of the things that we've really looked at. We gave a lot of thought to what can we do more on the gender equation, what can we do to support businesses run by women who face a lot of challenges. And we've built a very robust women in business proposition, and that proposition is really growing from strength to strength. We believe arguably that it's the best proposition in the market, with various facilities, including up to 10 million shillings unsecured facilities. You can borrow up to 50 million for discounted invoice discounting. So there's a number of very strong features in this, and we're seeing sign-ups really going from strength to strength. You'll remember we also launched our WhatsApp banking, which was the first in the market. It's an iterative product. Again, just showing that we want to be where our customers want to be, and that was encouraging. We've relaunched some of our digital business platforms, just to really make it easier and to have a better customer experience and to add functionalities, on there. Again, it's important we have all these channels so that people can just come and bank with Absa and get everything they need done in one place and in one-stop shop. We've formed more partnerships around the agency banking space. So we've signed up, one partnership where we get another 700 outlets. And this is a much stronger proposition than opening branches, which can be quite a costly affair with a lot of capex. And we'll be announcing in due course further partnerships to really take us as close to customers as possible, because we also recognize that we are in a cash economy. Not everything can be done digitally. So we need to be there as those customers have those needs on a day-to-day basis. And then we've launched our Novo FX, which allows you to do FX transactions, cross-border. You can literally buy FX and send it to somebody using our Novo FX app at very fine pricing, which again is very competitive for us. So when we look at this, we're proud of what we've done on the technology side, and we're continuing to invest. On the corporate and investment banking side, you'll remember we were the lead arranger in the East Africa Breweries medium-term note of 11 billion, and we thank them for the confidence and support for picking us. That was the largest transaction, I think, in the history, of the company, and again just shows the capacity and capabilities that we are now building up in our brokerage and investment banking business. If we look at our brand awareness, the business has been very focused on landing and managing the transition between Barclays to Absa. If you remember that Barclays had over 100 years of history here, there was a lot of trepidation about what is Absa. When we came in, we did research that showed the Absa recognition was single digits. I think it was about 4%. And we've invested significantly in investing in our brand and growing our brand. And you can see here, even from 2019, where we were 28%, and then 2020, guess what? We launched our brand, and then within a month, COVID hit, right? So all our plans, our best laid plans, could not be executed the way they did, and we pivoted, and focused in other areas where we could be of benefit and support to the community. And we're very proud that our brand recognition now is north of 92%, and we've won various awards. We're the second most reputable bank in Kenya as Absa, and we've got very strong metrics around colleague love, which is important. If you don't have colleague support and motivation, you're not going to be able to provide service to your customers. And then our customer experience scores are also improving every year, and we continue to focus on that. So I think that's very important for us as we move forward. On the colleague side, we were very proud and privileged to be awarded the top employer in 2022, but I guess it was for 2021 by the Top Employers Institute, which is a global authority which recognizes excellence in people practices. And this is really important for us because we have a series of companies, and subsidiaries, and we want to make sure that we are an aspirational place to to work, where people feel that they can contribute. And we really believe that our people are our strength, and we drive all aspects where people can play to their strengths and come and contribute. And you'll have seen our gender agenda is a core part of that, because we really believe in being an equal opportunities employer, because we believe that's the best way for us to sustainably grow our business. We've done some material cultural transformation programs over the last 5 years, and we've seen the benefits of that, in terms of people just introspecting, people building skills. We've opened new businesses that required hiring new people to come in and grow our businesses. And we've brought in many new sort of top-class thought leaders and leaders in their respective spheres to come and support our growth. So we've invested in our customer value proposition, which ultimately enhances our colleague experience on a day-to-day basis. And then with COVID, we had to pivot to new ways of working, which was largely working remotely. So we had to invest significantly in the tools and system accesses to allow our people to work from the most convenient locations, be it home, remotely. And now we're kind of transitioning more to hybrid ways of working. We recognize that human beings intrinsically do like to meet up, but we have to balance that, with making sure that we fulfill the government requirements around health and safety and COVID protocols. And we see as those are getting lifted that we are gradually increasing the face-to-face meetings such as this one. But interestingly, what we have found is that a lot of our colleagues actually prefer to work remotely. So I know a number of other institutions may have preferred their people to come to work. We want you to be able to work, obviously job allowing, in a way where you can be most productive. And we've seen our productivity measures go up, as a result. So we're quite excited about that. And we run various programs that allow people to contribute from wherever they are. And that has driven our customer satisfaction. If we move to the next slide. So in terms of creating shareholder value, this slide just really summarizes what we are looking for. We're very much driven by being a responsible, sustainable company that delivers reliable returns. And we've done so even through these difficult periods, whether it be the interest rate caps, doing the transition on the rebranding exercise, and then most recently COVID-19. So we believe we've built in resilience and agility into our operating model, and that has allowed us to deliver the kind of results we're seeing here. And we're very excited that from a dividend perspective, we're back to delivering 6 billion shillings worth of dividend with a solid dividend yield of 9%. And when we look at the dividend yield ranking, we're at the number 1 position. And our total returns, I think, are very pleasing at 32%. And a good share to be invested in. So we'll be paying out, and the board has recommended a dividend of 1.1 shillings, which is the same level as 2019. And we continue to look for ways that we can maintain or grow that dividend over time. We are still in uncertain times, and we need to make sure that we're still cautious, albeit optimistic. And as I said, we're investing in new businesses to deliver future sustainable growth. And that's why that informs our decision around dividends, and ultimately giving a strong return on equity, which Yusuf will share over time, which is important to our shareholders. Just to talk about sustainability, we are very committed to our sustainability agenda, and have focused a lot on the things we can do to embed our sustainability agenda into our business agenda. We call that our shared growth agenda. We believe if the community thrives, so will we thrive, and if we thrive, hopefully the community thrives. And we've stood up and taken a stance by becoming signatories to the principles of responsible banking, committing to strategically align our business with the Sustainable Development Goals, or SDGs, and the Paris Agreement on climate change. We became a signatory of the United Nations Global Compact, of which I sit on the local board here in Kenya. And ultimately, I think really it shows our commitment to looking after the environment, looking after people, whilst pursuing sustainable profit in a responsible way. And I think we've been recognized in a number of areas. The work we've done on the environment, around being recognized by the Kenya Green Building Society for championing initiatives that promote green economy and good green working practices and places. On the education and skills development aspects, we've trained over 200 young people on what we call ready to work, which are skills around employment and or running a business, where we teach you what is involved from that. And it's an online program that we run free for young people to be able to go through this. And we're partnering with KEPSA on the Ajira program and have set a target of training 1 million young people by 2025, just as a further commitment to this. I've talked about our commitment on the gender agenda. We've partnered with various different bodies, whether it's the UN Global Compact, the IFC, where we committed to take 10,000 women-run businesses international and give the skills there, our Women in Business proposition. I asked the team to go for a target of empowering 1 million women by 2025 and encouraging them to invest and be successful in their businesses, which will benefit Kenya. So we're making strong progress on these agendas, and this is a core part of our strategy and will be reported on our sustainability commitment reports in the future. So really, if we go back to the slide, it seems we lost all part. No, just go to the future one, the next one. Yeah, that one there. I think what's very pleasing and rewarding for our teams is that we've made good progress in terms of our strategy and our execution, but it's not just ourselves who feel pleased about it, that it's been recognized. And these are a number of awards that we have won. And I think being the second most reputable brand in Kenya even surpasses what we were under the Barclays brand. We're the second rated brand in Kenya for brands transforming lives. And I think that's very, very humbling and very pleasing that, that we're actually driving this, and we were the top performing brand in the financial sector. We've talked about the top employer awards. We've also won awards in our tech space, in terms of the best tech overhaul. We had huge projects during the transition. And we've won different awards in things like Islamic banking, corporate banking, as well as product marketing. So we're doing well. We are honored to receive these awards. And really we're going to continue to drive forward our strategy, to see further success in this area. Okay, so I think then with that, what we will do is I'll ask Yusuf to come and take us through the detailed financials. He will be able to give you those detailed breakdowns, and we'll follow Yusuf with Moses in terms of our future outlook. And then we will soon after that open for questions. So I think thank you for your attention, ladies and gentlemen, and I invite Yusuf to take us through those numbers. Thank you very much.
Just to echo what Jeremy has mentioned, glad to be able to, to speak to you, face to face. One of our colleagues asked me when we were coming here, what is a Teams link for us to be able to do this presentation? But then I told him the link is actually at Serena. So really glad to be here. Just as Jeremy has mentioned, I'll take you through the details of our financials. We released our results today in the morning, sent it to CMA, NSC. I'm surely hoping that you have all the details of the financials. So mine will be a brief, just giving some bit of details on those numbers. And then, of course, I'll be looking forward to your questions so that we can be able to shed more lights on these numbers. So just to start it off, which is on the balance sheet side for these reporting period, you're able to see on loans and advances a growth of 12%. And for me, what is very relevant is really when we look at the average growth in loans and advances, because these are spot balances, and whenever you have spot balances, if you have a skew, then you know that will definitely give a very different message, and that still for loans and advances is in double-digit, levels. When I look at the products that have done well, mainly on the side of business, wholesale banking, and so when we try and break these financials to the different businesses within the bank, which is business banking, corporate and retail, you'll be able to see on the side of wholesale banking, which is corporate and business banking, doing double-digit growth rates on these numbers, which really is an emphasis of what Jeremy has mentioned, the revampments of the economy, the pickup on the GDP, etc., that is now becoming very apparent. We supported a lot of our customers. Jeremy shared a slide, 2 years ago, where we supported about 30% of our lending book, about 62 billion in terms of payment holidays, etc., with a very big chunk on the side of retail. But then we continued on the lending, front. And then what we've seen in 2021, quite a number of the businesses that have put aside the investment programs coming, for these facilities, and clearly this is a sentiment of what that, entailed. I mean, just looking at on the lending side, and we are going to see a slide of for that. You see that the CBR rate came down early last year, and because of that, you'll see later on that the yields in lending, for the bank came down by about 50 basis points. On the other side, you're able to see the customer deposits growing by 6% year on year. Again, the average, which is more relevant, in terms of the implications on the financials, that's actually much higher than what you're seeing there. And clearly with that, then you'll be able to see that, and that's when we go to the slide on yields, that we've managed to bring our cost of funds down within that period. And that is actually testament when we try and break down these deposits between transactional deposits on one side, which is about 68% of the 269 billion that you're seeing, and the other side, which is on side of time deposits and savings, which then has really helped us in making sure that we can be able to bring our cost of funds down over this period. If we move to the next slide, which is on the side of revenue, just trying to break down how did we make the 7% revenue growth. You see on the top there, we are showing double-digit growth in specific products within the non-funded income, which Jeremy mentioned. A good one on the side of bank assurance, that was nearly 20% growth year on year. We have some trade fees, RMP products, and when you look at it holistically, the NFI you see year on year is a 5% growth. When we look at on the side of net interest income, you see a big delta compared to NFI, 8% growth year on year to take it to about 25.2 billion. And to my earlier point, the yields on lending came down, but then we were able to balance that more on the side of cost of deposits. And then the rest, third metric really is tied to the earlier slide, which is the balance sheet momentum. Revenue linked to on the side of deposits picking up 12%, and then on the side of deposit growing by 6% year on year. We're showing a pie chart, which is, to Jeremy's earlier point, the diversification of our revenue streams. And you can see clearly nearly 50% on the side of wholesale and retail. Exact figures are it's 46 and 54%. And really, if I was to jump on each of those sections, you see that the retail business, when we dive into the numbers, what informs this growth, you will see that when we prepare our integrated report, the customer numbers in the bank has actually picked up, and not just the actual customer numbers, but then also the active customers who are transacting with us, on a day-to-day basis. You see that has actually picked up. The digitization agenda with all of this new innovation, WhatsApp banking, 700 plus agency banking, all of that helping the retail business, pick up on the revenue pool in this reporting period. And then an important one, which is again tied to the revenue diversification, a really capital light, revenue line, which is a bank assurance. I mentioned that peaking, year on year by over 20%. If I look at on the side at the top there, the markets business doing extremely well, especially on the RMP products. And when we look at the detailed financials, you'll be able to see off-balance sheet items, swaps, options actually peaking aggressively during this period. Again, speaking to the fact that, the economy is opening up, and as a result of that, some of these revenue streams are coming through. Looking at corporate primacy, when we look at customer primacy, a key agenda for the corporate team. And then when you look at it, that is picking up, which basically speaks to quite a number of our customers are now establishing us as their primary bankers and doing their end-to-end, banking needs, which then, of course, helps when we look at, the double-digit revenue growth that we're seeing in our wholesale, both on corporate and on the side of BB. Tied to the balance sheet as well, when you look at the balance sheet, off-balance sheet items, you see a growth of about 30% on guarantees, LCs, and acceptances, really talking to, again, the economy opening up and making sure that, we're able to serve those customers. Going to BB balance sheet momentum, very, very important. Double-digit growth on the side of BB. And business banking for us, SME is included in this as well. And then the innovation agenda, for example, the one on women in business, also coming through. If I was to move to then the slide on just looking at the rates, a very important slide, I must say. If you look at that chart, at the top, that shows the average yields that we are lending to our customers. You see that starting at 11.8 back in December 2018, and that has come in tandem with the line below, which is when we are looking at the CBR rate. You see CBR rate coming down and also our yields coming down. I think this differentiates us, ladies and gentlemen. If you are to look at the results for other banks, you will see the CBR rate coming down, but the average yield either sticking at same level or actually going up. And this is what differentiates ourselves. We are passing the entire of that benefit to, to our customers. And as a result of that, that informs the 50 basis point drop that I've mentioned in terms of just the yields, which again, of course, if you try to link it on the interest revenue, on the lending, on loans and advances, you'll be able to see that, loans and advances has peaked 12%, but then you don't see a significant jump on the interest income line. Moving to cost slide, you see a 16% drop year on year. I must say, lots of investment has been done, be it on the side of automation of our back office processes, be it on the side of giving our customers alternate channels for them to be able to, to transact with us. If you look on the right side, you see over 90% of our transactional volumes right now are actually going through alternate channels and not the traditional brick and mortar, branches. If you look at that back in 2013, you can clearly see that branches accounted for about 66% of the transactional volume. That has really changed. As a result of that, the cost discussion just comes down. All the line, be it on the side of staff costs coming down by about 3%. You look at areas on, property cost, other costs, all of these are just coming down, driving the efficiency agenda, and of course informing the bit on cost to income, ratio. One cost that I must mention also, we've completed the branding, the separation exercise, and so in these financials, we don't have the separation cost relative to what we had back in 2020. If I go to the slide on risk, an important slide as well, and this is really testament to what we are seeing in 2021. We took quite a huge provision When we did all those payment holidays, 62 billion, 30% of our lending book, it meant we could see a strain. And if you look at IFRS 9, it speaks to, in the first instance, where you actually get in default. And if you look at that one, on the side of improvement in portfolio quality, it means a significant portion of our customers are able to meet their regular monthly repayment. So the default has come down significantly relative to what we saw back in 2020. Jeremy mentioned of the 62 billion that we gave payment holiday, over 95% of those customers have actually regularized their accounts, and that's testament to that point. And then the one on COVID-19 provisions coming down by about 1.8 billion. We made significant provisions back in 2020, and based on IFRS 9, where we're looking at, you either have a default, which then you take an impairment on it, or when you're looking at forward-looking, metrics, which is the macroeconomic, overlays, we are basically speaking to, if we are to project default in future, is that positive, is that negative? 1 year ago, it was negative. And when you look at this, that risk has come down significantly, and hence the releases on provision. We've put some important ratios just to show you the prudence of our model. If you look at gross NPL ratio, we are at 7.8%. The industry is at 13.1%, quite prudent when we are taking impairment. And then on the coverage ratio as well, while the industry is at 65%, we've actually covered ourselves sufficiently when you're looking at a ratio of 78%. I think just one final comment before I go to the slides on the summary on financials. We are still not yet out of the woods. There's still some sectors, industries that have still struggled, especially last year. We are seeing that changing, especially on the side of hospitality. When you look at tourism, that has been a strain. And so still, because of that, we are still holding some of the forward-looking provisions, which then, of course, can only be released depending on how those sectors, evolve. If I move to the slide on financials, this is just bringing all of it together, and I think some good record performance, I must say, be it on the side of revenue. Revenue growth of 7%, 36.9, we try and compare to 2020, 34.5, but then we also go a notch higher and compare that to the pre-COVID period. Revenue then was about 33.7, and you can see that's actually exceeding even the period before the, the calamity that, we've just been going through. The record profit after tax, 10.9, representing 161%, is higher than the it's higher than the profit that we had back in 2019 of about 7.5 billion. So a good story, as well, where we're comparing during the COVID period, but then even the period before COVID, a testament on the financials that, we have. I think the balance sheet summary, we've covered a lot of that, peaking before pre-COVID period compared to 2020 and even the period, under discussion. If I move to the slide on some summary of key ratios, just to appreciate what does this mean on some of the areas that, the ratios that we really focus on. Cost to income ratio, Jeremy mentioned, coming down over the period, now at 45%, an ideal ratio, a strike of, a good balance in terms of revenue and cost, and an area where we are saying is actually sustainable. Yields on loans, I mentioned, coming down by 50 basis points because of the CBR, that, the slide that I've already shared. Managed to balance that a bit because of the cost of funds coming down by 10 basis points to 2.3. And then, of course, the return on equity at 19.3, which has actually been able to support us to be able to go back to, dividend declaration. If I go now to my last slide before I call my colleague, this is just looking at the health of capital, liquidity, all of those metrics you can be able to see, be it the core capital ratio at 14.6, a headroom of about 4.1%, total capital at 17.1, again, headroom of 2.6, hence the declaration of dividend. And we've actually tried to, to look at different metrics to see that indeed it's actually sustainable. And then, of course, liquidity ratio having headroom of about 18.3%. I think in conclusion, what I'll say is good sets of financials, record performance. We've compared to pre-COVID period, a good story, I must say. And I think for me what is important is we have such a good base, be it the balance between loans and advances, be it on the side of capital, liquidity, some good buffers, which really puts us in a very good position when we start looking at 2022 and beyond in terms of just the next agenda. And I think for me what's very important is separation is behind us. Really, the focus right now is executing on the strategy, which is at this point I'll request Moses to come and cover just an update on the strategy and some key guidance on the outlook side. Thank you.
Thank you, Yusuf, and good afternoon, everyone. I'll make some forward-looking insights, and just to mention upfront that there's no conversation these days about forward-looking insights without considering the operating environment that we are in. We've got this Eastern European crisis, which might have ripple effects across the world. And locally, we have our unique 2022 year. And so any potential economic interruptions might lead to or might trigger material restatements of the outlook conversation. So much of a caveat. I think the first thing is, looking forward, we have a very clear strategic direction. We are very pleased by what we've been able to achieve the first 3.5 years of our 5-year strategy, 2018-2023. We said we wanted to achieve 3 principal financial measures by 2023. One was grow revenue to gain market share. Secondly, drive transformation for our efficiency ratio to come below 50%. And then lastly, to make sure that our returns are above our cost of capital by about 5%. As at the end of 2021, we've met 2 out of those 3 principal financial measures. And we believe this gives us a base, a very solid base to think about growth and to sharpen and refocus our growth, transformation, and return strategy on growth for 2022 and 2023. So how are we thinking about growth? And what are these priorities that will enable us achieve growth objectives? I think first is we have to build propositions for what we're calling new battlegrounds in banking. There's opportunities we see in consumer payments. We see opportunities in mobile lending. We see opportunities in asset and wealth management. We see opportunities in investment banking, both financing, capital markets, advisory. And these are areas where we need to just sharpen our propositions to make sure that we are participating fully, where today we are only participating in 80% of the revenue pool in the market. So the 20% we have to address. So that's a core priority for us in our growth strategy. The second of the 3 priorities for our growth strategy is strongly growing and diversifying our retail and business banking. We have a retail business that must continue to diversify itself in line with the other opportunities ahead. And then we have a significant opportunity in business banking. So in fact, when we look at our entire portfolio, we think we have a real good shot to really grow in business banking. And so as a second big priority is how do we strongly grow and diversify our retail and business banking. Then lastly is around corporate and investment banking, where we believe we have capabilities to build a regional powerhouse in terms of a CIB franchise. We have the capacity to do it. We have the relationships and the capital being part of a group. And so we really want to build our corporate and institutional business to be quite a standout business, not just in Kenya, but across the region. So in a nutshell, as we think about the coming years, is how do we take the advantage around transformation and returns, carrying some cost capacity and the capital we need, and just focus on growth. And obviously in light of the operating environment, which I gave a caveat on. I think secondly is we have to fund that growth. And to fund that growth, we have to do it in a way that also deals with the dominant challenge of not just Absa, but banking today, which is digital transformation. If you go to the next slide, please. So the momentum on CapEx will begin to give you insights on what we're doing to fund that growth and to invest in the right places. You've seen we're accelerating our CapEx investments. 2 billion this year compared to $500 million just about 4 years ago. And we need to, or we intend to focus this CapEx in 3 broad areas. When we think about digital transformation, unless digital means something to customers, so the front end, in terms of whether it's how you transact, buy FX, or open an account, then it means very little to customers. If it doesn't mean anything to customers, then perhaps there's a question mark around digital transformation. So how do we transform the front end to make it more easier for customers to deal with us? Then at the back end, how do we continue automating? We don't believe there's a ceiling to how much we can automate. And so how do we continue automating safely and soundly to make sure that over 60% or 80% of our processes are straight through and automated, and create capacity to move that capacity from the back end to make sure we're doing more selling and service at the front end. So it's not about loss of jobs, it's how do we move the capacity to the right places. And then lastly is simplification. When you think about HR, finance, risk, how we simplify ourselves to deliver a superior customer experience is another broad area where CapEx is going. Thirdly, we have to think about our cost philosophy in a slightly different way than we have in the past, for good reasons. And just on a light note, it's very pleasing to not have to explain normalization like we have over the last few years. And our previous cost philosophy has been, we have one-off expenses to rebrand and transition, and so it's inevitable we're going to spend a quite substantive amount of costs. Therefore, we have to think about holding our operating expenses flat and net making sure that when you exclude those one-offs or when you normalize, our costs were not going to go above inflation. So that was the thinking, which was quite prudent when we look back the last few years. I think looking forward, we're more thinking about funding the growth and increasing costs as long as we can afford it in the P&L. So when you look at our cost-to-income ratio, we're at 45%. Assuming we keep it at 45% and revenue grows at GDP, it means your cost will go up. So cost going up will actually be a good indication that we are funding growth, and we're happy to stay at mid-40s. And just taking that simplistic assumption around revenue at GDP, cost-to-income ratio staying at 40s, Jeremy has given a guidance around there's no intentions to go lower to 30s. It does demonstrate lack of ability to look for growth opportunities. So assuming that you have this additional cost capacity that we have to fund growth. And so we're going to think about, as much as we want to increase cost to drive revenue while keeping the ratio unchanged, thinking about our costs structurally still continues. So automating still continues, and we'll pay focus to that. I think fourth is we have to continue taking deliberate actions around operating leverage and basically, how we ensure that our efficiency levels don't hold back our growth strategy, and financial leverage. To make sure that capital allocation does not necessarily have to damage returns for our shareholders. So the broad guidance is, as always, returns above cost of capital by 5% through the cycle. Cost-to-income ratio at mid-40s, and how we think about these two things simultaneously is going to help us drive our growth strategy. And then number 5 is capital management. And what you notice on these numbers is that in 2020 we suspended dividends so that our capital ratio could improve, or the buffer could increase to 2.7%. So we ran a common equity tier 1 capital ratio internal target of 12%. 2020 was at 14.7. To do that, we had to suspend 6 billion of dividends from the prior year. And we had to apply that capital preservation mindset to make sure that we are building a resilient business coming out of the crisis. In 2021, with 6 billion of dividends back, our capital buffer post-dividend is 2.6. So it tells you the 2 years are comparable on the buffer, but we've returned or resumed dividends, which tells you that we took perhaps the right and tough decisions in 2020, and we now have got a very strong base, rock solid capital, not only to pay dividend, but to continue growing our business. So when we say a growth strategy, the capital to support it is actually something we see that we have. The 2.6% buffer to the internal capital requirement means we can increase our risk-weighted assets by 60 billion. Now 60 billion is like 120 billion plus of loans and advances without touching the internal buffer. So the capital is quite there to support our growth ambitions going to the future. And I think finally is how do we think about risk, particularly credit risk, and the associated margins we make to make sure that A, we are continuing to support the economy and businesses, which means our loan loss ratio might increase slightly, but if it does because of supporting our customers and the economy in general, and that comes with increased revenues and margins, it's a win-win for all broad stakeholders. So the intention for us is perhaps to take back our loan loss ratios or simply the amount of risk we are going to take going forward to pre-pandemic level, to the 2.2 level, currently at 2%. And hopefully with risk-based pricing coming to life, our margins can also begin to improve slightly. So it's a mindset of how do we take a little bit more risk to support our customers and the economy, and along the way pick up some revenue increase going forward. And this is particularly important because when we look at who we used to be in the past and our risk playbook, or how we thought about risk in the market and who we are today, there's perhaps a closer pulse on what's happening to the local market as Absa on where the opportunities are. So just to conclude, we're in the 4th of 5 years of our strategy. We're very pleased to have achieved results for 2 pillars out of 3 pillars ahead of time. And the effort looking forward is how do we switch on the growth engine of the organization and do that safely and soundly, with the caveat of we always have to be careful on the macroeconomic environment, which is something we are watching closely. I'll ask Jeremy to come and conclude before we go to Q&A. Thank you very much. Jeremy?
Thank you, Moses. So I think as we really reflect on 2021, we're very proud as management, with the performance we've delivered. For us, it's a record performance, and I think it really reinforces our confidence that the actions we've taken over the last literally 8-9 years have brought us to this point. And I think what's even more pleasing is the fact that we have actually gone through some fairly significant challenges, whether it was interest rate caps which decimated our margins, or whether it was COVID. So we feel we have a resilient business. We feel we've built business models that are apt for the future, and will continue to be agile and to respond to the needs of the time. We've got an exciting strategy which is focused on opportunities that we see that we can be able to grow in. And what's very encouraging with the areas that we focus on is where we have focused, we've managed to grab customers and we've managed to grow our market share, because we take very seriously developing product propositions and customer offerings that are relevant to our customers. Because at the end of the day, the customer is front and center of everything. That is obviously supported by being a very digitally led bank, because we believe by using digital solutions and using data to drive our decisions, that we can actually get the best optimal balance between revenue growth and risk in terms of delivering financial outcomes for our shareholders, albeit predicated on being a force for good within society, because that is very precious to us. We're very proud that we have resumed dividends, and we know that's important to you as shareholders. So we at the time when we looked at last year, the previous year, 2020, we really did not know what was in store for us from a future perspective. There's still uncertainty now, but we're well capitalized. We've got great plans, and I think the confidence is shown by our investments in technology and people. We are hiring for our new businesses, and I'm sure that those businesses will deliver. So we're very encouraged. We have a strong core franchise. We're getting into new revenue streams, and that will push up our performance in the future. And we ultimately, at the end of the day, have a great set of people working in the bank, for the bank, to deliver customers the service and experience that they ultimately want. Because if we do that, we remain confident that we'll be very competitive and we'll see our business grow from strength to strength. So I think with those words, thank you so much for your attention. We will move to the next part of the session today. I'll hand back to Charles to explain how that will work. So thank you very much for your time and attention.
Thank you so much. Thank you, Jeremy. Thank you, Yusuf and Moses, for spending the time to just paint the picture in quite some detail of what the year 2021 meant for our bank. And I think the room and the people following us online will all agree with me. It's a great story. It's a great story of resilience. And what we say at the bank is our resilience is built on the inspiration which we are drawing from our customers. The men and women who are working out there on the streets of Nairobi on jobs or running businesses, who defy odds and big challenges on a daily basis, to keep delivering and pursuing their growth ambitions. Those are the people that inspire us, and our commitment is to continue supporting them. Now, I think we put a pause there and just say a big thanks to the online audience, those of you who've been following us on YouTube, on LinkedIn. We hope you found this session insightful and useful. We hope that you've gotten the details that you'd require. Feel free to continue engaging with us. You can drop us your comments on both these links or whatever kind of feedback you have. Remember to use our hashtag, which is Absa FY 2021 results. For now, those of you who are watching us online, LinkedIn, YouTube, it's a good afternoon to you.